Your friend Jim is focused on the next generation of AI. The next door neighbor, Bob, he's trying to figure out the next breakthrough in biotech. Both these guys are trying to find the next big market trend, but they're both missing the most basic building block for the future of markets and our global economy. The world is quickly running out of people. Welcome to the Dean's List, everyone. I'm Dean Lolkin, investing veteran and private credit CEO, here to help you grow your wealth. Today I'm going to show you three shocking truths about demographics that are going to completely change how you think about the future of markets and exactly what you need to do about each one of them. First, we're going to talk about why America's workforce is about to hit a wall, and nobody sees this wall coming. The companies already solving it are ones that you need to know about. Then, the massive wealth transfer that's already happening, and how to position yourself ahead of it. And finally, why the global balance of power is shifting faster than anyone realizes. And where do you need to be before it's obvious? Watch all three parts to make sure that you're fully educated on this topic. These trends are going to shock you, and more importantly, I'll show you exactly how to profit from them. Let's talk about a number that's going to change everything you think about economic growth. 1.6. That's America's current fertility rate. For perspective, we need 2.1 just to maintain our population. That's how many kids each potentially fertile woman is going to have. But here's what makes this truly shocking. We've been below replacement rate for over 50 years. It's not some COVID blip. It's not a millennial issue or trend. It's a fundamental shift that's about to hit our workforce like a tsunami. So let's look at the numbers. Labor force growth. We've dropped from 2.5% annually in the 1970s to just 0.2% right now. Our worker to retiree ratio in the US was 5 to 1 in 1960. Guess what it's going to be in 2035? 2 to 1. So peak worker, right? The total US workforce is going to peak around 2028, according to most estimates, without immigration. And we know immigration is currently under a lot of pressure, right? Especially with the Trump administration coming in. This workforce wall, as I call it, impacts everything. Our GDP could potentially drop by about 1.5% on an annual basis. Historical GDP growth in the US has been over 3%. If the new normal is 1.7%, that could make our economy $4 trillion smaller by 2030. So what's the smart money already doing about this? Well, for one, they're investing in automation leaders. They focus on companies with proven ROI metrics. They look for recurring revenue models, and they target market share leaders, the bigness that we talk about on the Dean's List over and over and over again. Of course, you want some ideas. Let's give them to you. Rockwell Automation, ticker ROK. Do some research on Emerson Electric, EMR. One of my favorites, ABB Limited, ticker ABB from Sweden, and Teradyne, ticker TER. Get to work, take a look. Then let's talk about labor productivity solutions. We all understand software is the present and it's also the future. And software that multiplies worker output. AI-enhanced workflow tools, training and upskilling platforms, remote work enablers. Like ServiceNow, ticker NOW, Workday, ticker WDAY, Monday.com, MNDY. And one of my favorites, the Romanian UiPath, ticker PATH. That one's been beaten down a bit because people think that AI is going to remove the need for these little robots that UiPath is creating. But I think it's worth taking a look at. And most importantly, stay invested in the Magnificent Seven. That gives you exposure to all the top LLMs, right? The AI that all of you love, right? From Perplexity to Claude, to Gemini, and obviously to ChatGPT. Now, there are some strategic sectors that institutional investors are targeting given these trends. Number one is healthcare automation. Number two is manufacturing robotics. Number three is logistics optimization. And four, construction technology. Make sure that you're up to date with all four. By 2030, 1 in 5 Americans will be over 65. But that's not the shocking part. What's coming is the largest wealth transfer in human history. And investors are completely missing how to position for this trend. The baby boomers, our parents, our grandparents, 84 trillion in assets, 50% of US household wealth, and 40% of all consumer spending. And guess what? Even today, 70% of all disposable income goes to them. So, what does that mean for your portfolio right now? There's a healthcare revolution going on. Why? Because if you look at spending by age, folks under 45 are spending maybe $4,700 a year. The 45 to 65 cohort, double that at $9,600. Now, over 65, today's healthcare spending is almost $20,000 per year for this group. And once they're over 85, that goes to $35,000 a year. We're all spending lots of money on our longevity and extending our lifetimes to maximize the quality of life that we can have with our loved ones. So, as an investor, where do you focus? Medical device leaders in chronic conditions, home health technology platforms, specialized pharmaceutical companies, and one of my favorites, healthcare REITs with proven operators. There's a silver tech explosion going on. Remote monitoring for healthcare is going to be a $117 billion market in 2025. Digital health is growing at an 18% annual rate. Elder care tech is going to be a $45 billion market within the next few years. And age tech funding from venture capital is up 4x just in the last 5 years. So where do you position yourself? Well, let's get to remote patient monitoring leaders. Let's go into digital health platforms with senior focus. Let's make sure we have exposure to AI diagnostic companies and age tech innovators. So one of the most important trends that I follow is real estate transformation, given the aging demographics of the United States. I love 55 plus communities. That market has grown by 8x over the last decade. Now, home modification is a $14 billion market. Think how your elderly grandma is going to get up the stairs when she can't do that anymore, right? She's going to need some sort of solution, some sort of little elevator, a little chair to get her up there. Think about senior housing demand. That's doubling by 2040. And multi-generational homes. I expect that market to grow by 3x in the coming decades. So, some investment targets for us all to think about. Senior living REITs, right? Real estate investment trusts, home modification leaders, and smart home technology companies, as well as healthcare facility operators. There's another trend to consider given the graying of our society, and that's the wealth management revolution. There's an enormous opportunity there. There's an estate planning surge that's already happening. Financial advisor demand is exploding. Insurance products are evolving. Banking services are being transformed. So what should you do? Well, target the wealth transfer facilitators and focus on digital advisory platforms. Look for estate planning innovators and watch for fintech senior solutions. Of course, let's get into the ideas that'll help you capture some of these trends. On the medical device side, do some research on Intuitive Surgical, ISRG, Dexcom, DXCM, Insulet, ticker PODD, and Edwards Life Sciences, ticker EW. Now, healthcare REITs. There's Welltower, ticker WELL, Ventas, ticker VTR, and HealthPeak, ticker PEAK. Healthcare services? Well, United Healthcare has been in the news a lot lately, ticker UNH. Elevance Health is worth looking at, ELV, and Humana, ticker HUM. Here's the reality nobody's talking about. China is aging faster than any society in history, and it's creating both massive risks and huge opportunities. China has a working age crisis. Its peak was 2014 at 1 billion workers, and they're losing 6 million workers every single year. Now, their workforce is going to drop to about 600 million by 2050, according to estimates. And that will double their dependency ratio. What does this mean for your money? China exposure strategy has some amazing risks. Their property sector right now is 29% of GDP, or gross domestic product. 50 million empty apartment units are sitting around, and that's going to grow. They have a pension shortfall of $540 billion expected by 2030. And the growth potential for China that we've all grown up with is going to drop from about 8% annually to about 3% in the coming decades. So, what are some action steps we can all take to make sure that our portfolios are China ready? Well, we should reduce exposure, if we have any, to Chinese property developers. Focus on automation-ready Chinese companies and watch companies targeting elderly Chinese, as opposed to the younger generation. Now, the opposite of China today is one of the biggest countries, most populous countries in the world, and that's India. Now, India is paying demographic dividends. They're not affected by the same trends that we are here in the US, that Japan is, China, and most of Western Europe. So India, by the numbers, the median age is 28. They're adding 1 million workers every single month. And their tech workforce, I mean, you guys know this, it's the world's largest. Let's think about which American tech companies have Indian CEOs. I can think of Microsoft and Google off the top of my head. Now, there's a manufacturing shift accelerating there as well. So where should you position yourself? Well, Indian manufacturing leaders like Tata, tech service giants, digital payment platforms, infrastructure developers. And beyond India, there's also Africa, presenting an emerging market opportunity. There's 1 billion people in Africa under the age of 25 by 2030. That labor force is expected to double within the next 25 years. And their consumer market, a $5 trillion market by 2050. They're experiencing the fastest urbanization rate globally. So, in Africa, our investment targets would be mobile payment leaders, consumer goods companies, infrastructure projects, and tech education platforms. There's a developed market strategy shift that you need to be a part of. The developed market has rapid automation needs, innovation focus, immigration competition, and pension system stress. So we're going to focus on automation technology leaders, innovation-driven companies, healthcare tech, and productivity solutions. So let's give you a quick global portfolio checklist. You're going to reduce exposure to aging market real estate, labor-intensive industries, unfunded pension systems, and traditional retail. You're going to increase allocations to automation leaders, healthcare innovators, emerging market consumers, and digital infrastructure. So, some ideas from some of these important themes. Number 1, get some India exposure. The iShares MSCI India ETF, ticker INDA. Or the Wisdom Tree India Fund, EPI. Take a look at those. For emerging market consumers, look at Mercado Libre, ticker MELI, PDD Holdings, ticker PDD, and C Limited, ticker SE. Global automation leaders like ASML, Keyence, KYCCF, and Fanuc, ticker FANUI. And of course, digital payments, you know these guys, Visa, MasterCard, and PayPal. Make sure you do your research. Here's your action plan for these demographic shifts. Immediate steps for the next 12 months. Audit your portfolio for these demographic risks we've just gone through. Check your China property exposure. Make sure your ETFs aren't overly exposed to this trend. And assess aging market exposure and any concentrations. Review your automation positioning and position yourself for the silver economy. Healthcare innovation leaders, elder tech pioneers, wealth transfer beneficiaries, and build a global demographic advantage. You can use Indian manufacturing exposure, African consumer growth, automation tech leaders, or some combination of all three. For medium-term moves over the next 2 to 5 years, we're going to be looking to see how our portfolios should be shifting from the largest US tech-oriented companies that have been driving most of the gains in our markets over the last 10 or 15 years, to see if the dollar weakens and if bond yields decline here, if we should be reallocating more to foreign and especially emerging market stocks. So we might be increasing allocations. It might not be tomorrow. It might not be in a year. It could be in 2 to 5 years, but we'll be increasing allocations to healthcare tech outside the US, productivity solutions, emerging market leaders, and reducing exposure to labor-intensive industries, unfunded pension systems, aging market real estate. Again, remember to watch for the opportunities we talked about in African infrastructure, silver tech innovation, and global automation. Demographics are not just numbers. They're a roadmap to where money will flow next. The winners won't be those who wait for these trends to become obvious, but those who position right now. This is the Dean's List. We expose the market patterns nobody's talking about. And if this analysis opened your eyes, which I hope it did, make sure you follow for more insights. Hit that like button if you learned something new, and comment below. I want to know what demographic trends you want me to break down next. I'm Dean Lolkin, and I'll see you on the next one.